Welcome to Fresh Talk News Channel. Today, we're diving into the latest market-shaking development, the pause heard round the investing world. On Wednesday, the S&P 500, GSPC, surged 9.5% after President Trump announced a 90-day pause on reciprocal tariffs for most countries. However, he intensified pressure on China by raising tariffs to 125%. The tech-heavy Nasdaq Composite, IXIC, skyrocketed 12%, marking its second-best day on record. Meanwhile, the Dow Jones Industrial Average, DJI, jumped 7.8% or roughly 3,000 points. Only 9 stocks in the S&P 500 closed in the red. Among them were slight losses for consumer-focused names like Dollar General, DG, down 1.9%, and Kroger, KR, which dipped 0.8%. On the flip side, momentum favorites such as Tesla, TSLA, and Nvidia, NVDA, roared back with massive gains of 22% and 18% respectively. Still, volatility remains a concern. A baseline 10% tariff is still active, and Trump could reverse his decision at any time. Companies like Delta, DL, and Walmart, WMT, continue warning about the negative effects of the 2025 trade war. As a result, all three major indexes were down about 2% in pre-market trading Thursday. This dramatic shift triggered a flurry of responses from Wall Street strategists, many of whom had been warning of deep recessions and slashing price targets just days earlier. Earlier Wednesday, Goldman Sachs chief economist Jan Hatzius raised his recession probability forecast to 45%, making a U.S. recession his base case. But by the market close, with stocks soaring on the tariff pause, he reversed that call and said a recession was no longer the likely outcome. Chris Morangi, co-chief investment officer of value at Gabelli Funds, told Yahoo Finance, investor confidence and the predictability of U.S. policy have certainly taken a hit, maybe not permanently, but definitely in the short term. We're not going back to where we were a week ago, or even 3 months ago. Here's what other Wall Street experts are saying about President Trump's 90-day tariff pause. James Rossiter, head of global macro strategy at TD Securities, we believe the impact on the U.S. economy remains significant, and that the Fed will likely implement meaningful rate cuts this year. The first cut may come in June, although there's uncertainty. Inflation could rise toward 4%, unemployment could hit 5%, and there's still around a 50% chance of recession. Stephen Zaccone, Citi retail analyst, this news provides some relief for retail stocks impacted by tariff concerns. But with China tariffs at 125%, we're still facing significant challenges: product cost inflation, necessary price increases, and negative earnings pressure for many retailers. Mike O'Rourke, chief market technician at Jones Trading, the president's tactical retreat is a clear positive. But this isn't how to manage an economy. Trillions of dollars are swinging intraday based on one person's decisions. Whether this is a true tactical retreat or a disguised capitulation remains to be seen. Either way, investors should price in a higher equity risk premium. Michael Farrelly, J.P. Morgan economist, the drag from trade policy has eased somewhat, so the risk of recession is less clear-cut. Still, we believe a contraction in real activity later this year is more likely than not. Despite the decline in Chinese import share, the overall tariff increase since Inauguration Day amounts to over $300 billion in new taxes. Planning for capital spending remains difficult in this policy environment. With the next major trade policy update expected after Independence Day, we now expect the Fed to delay any rate cuts until September, instead of June. We project the top of the fund's rate target to fall to 3% by Q2 of 2026. Thanks for watching Fresh Talk News Channel. Don't forget to like and subscribe for more news and updates.